I suppose a couple of things that I'd just like to outline before we get stuck in too much. I don't know various people's level of knowledge in this area, so I'm quite happy for this to be open and to discuss as we go along. More so because it's really not a clear-cut area. It's quite a grey area in terms of the tax side of things. And so, you know, any experiences or discussion that you'd like to have on these issues, you know, I welcome. So, looking at what captives are doing, I mean, we're doing everything a normal insurer would do, really. There's not one thing more than another that's being written, but I see a lot of property and general liability lines being written on sort of global basis on global programs. Where we find quite a few issues coming up in terms of taxes and premium allocations are on the excess layers and on the DICDIL coverages, where, you know, it's not necessarily quite so clear cut. There's not that easy link necessarily to the various EU states. So those are sort of what I see to be common areas where the issues arise. So the first question really is, when do EU tax liabilities arise? We have some overarching framework provided by the EU. It was discussed briefly this morning as well. Essentially, what we're working with for taxation purposes are 4 rules. The first rule is the risk is located in the member of state where the property is located. This is fairly uncontentious. It's quite easy to work out where the building is. The next rule is the risk is located in the member state of registration where the insurance relates to vehicles of any type. Again, you'd think that's fairly straightforward, but as Peter was mentioning earlier this morning, you have different interpretations of what vehicle is. So, as you said, the Maltese, for them, a vehicle of any type is a car. And for the UK, a vehicle of any type is a vehicle of any type, including aircraft and ships. The third point is sort of a minor one, really, in relation to travel policy. And then the fourth one is the interesting one. It's the catch-all. If you don't fit into any of the above, you've got to look at the member state where the policyholder has habitual residence. So we then have to think about that final point, really. What is the member state where the policyholder has habitual residence? And I sort of bring it up every time. It is the one piece of case law that we really like in IPT, is the Caverna case. Looking at Caverna principles, but it's one that maybe separates Europe from the rest of the world. For any that aren't familiar with the Caverna principles, I'll just have a quick run through. Essentially what was decided there. The fact pattern was that UK parent company was taking out a liability policy for its group, and therefore the Dutch subsidiary was covered under the policy. The Dutch authorities argued that because there was an establishment in Holland, they wanted their share of the Dutch IPT. However, the IPT had all been accounted for in the UK because Caverna, were the policyholder in the UK, Caverna UK. The court essentially found, yes, there is a risk in Holland, in the Netherlands. No, there doesn't have to be any recharging of premiums, and no, the policyholder doesn't even have to know that they're covered. The Dutch subsidiary doesn't even have to know that they're covered under the policy for it to be there, for there to be a risk there. Now, why is this important? Well, there's slight conflicts maybe with practices outside the EU. So non-EU insurers working in non-EU markets generally might have sort of different interpretations of establishing where taxation should occur. Numerous different scenarios, the location of the insured, the location of policyholder, location of transaction, it goes on and on and on, and it varies from country to country. Final point just to mention here in trying to establish when you've got an EU tax liability, as I went through this morning, the ECJ case on life premiums. New case, and how it's actually going to work in practice is still all being ironed out. I won't go through the ins and outs of the case again, but essentially insurers need to be looking at where premiums are being paid from in terms of life premiums. What hasn't really been addressed is what rules should apply when it comes to, say, group policies, which would possibly be more interest to the captive market. And it appears rather like it's going to be down to each government to interpret the rules specifically for themselves. So whether you're going to have to actually drill down to the location of each insured under the policy when the payment is made, or whether it can be considered as the parent's policy. I fully expect there to be several different interpretations on that. So we've had a very brief look at how we know how to identify an EU tax liability, or where there will be one, or at least where there will be a member state's right to tax a premium. But when will this issue actually arise? And I've just listed out a number of scenarios that I come across that I see this issue of EU taxes arising for non-EU captives. New programs, quite obviously, so maybe trying to cut costs, bringing in a lot of fronted programs, previously reinsured programs, and write direct. Just new captives, that sort of obviously can have EU risks there. Another common one are new countries being added into existing programs, maybe through acquisitions of a local subsidiary or the like. And so you've got a program in place that is working, and then all of a sudden you found you've got a French risk on it as well. Internal audit and review. I mean, as we've mentioned this morning, this is becoming bigger and bigger and bigger issue for insurers and also companies in general. You know, you look at the likes of the Vodafones, the Amazons, tax is coming into focus a lot more, so there's a reaction to that to make sure that there is all that audit process in there and that we can justify everything that's been done. We can explain all of the financial affairs. So I've seen an increase in internal audits, questions being pushed back from my clients' internal auditors, and that can sort of say, well, okay, as a fiscal representative, as a fiscal agent, I can only file what you tell me to file. If the captive hasn't even identified the risk, I can't even begin to solve your problem. So there's internal audit, and I suppose added to that maybe external audit or an external health check. You know, it's not unknown to get a third party in to sort of have a look through your current process for IPT. Tax authority audits, obviously, again, they're on the increase. Tax authority inquiries are going up. And not just of the captive. In fact, it's probably more focused on the audits of the parent, of the policyholder, making sure that on these big corporate policies, their premium taxes have been correctly accounted for. And when you come to the EU with a non-EU vehicle, that's the way the tax authorities are going to find you. The HMRC is not going to necessarily be chasing all of these Bermudan-based captives for their insurance premiums. For them, the easy way is to just knock on the door of their taxpayer for VAT and just say, Can you show me your policy? Can you show me that you've accounted for your premium taxes accordingly? The final point up there, international tax enforcement arrangements, and I've got a question mark against the end of it. There's a lot of talk about all this information sharing and cooperation between governments and tax authorities, but really I've not seen that come to fruition yet. Certainly not in terms of premium taxes, and indeed I don't really know how the Bermudan tax authority can assist HMRC. They won't know the premiums being written, they won't know the allocations of those premiums being written out of Bermuda. So maybe something for the future, but not right now. So before I sort of get on to the maybe more nitty-gritty of it, are we all up to speed? Is there any thoughts so far, or shall I just plough on? No. So this is where I start putting in my caveats. Where can we file? And this is essentially a regulatory question. And I am not a regulatory expert. I'm not a lawyer. I deal with taxes. But the simple answer, simple high-level answer, is you can file taxes where you're authorised to write insurance. But non-admitted and non-permitted insurance contracts are written. I'm aware that they're happening quite a lot. There's certainly a lot of allocated premiums which aren't necessarily being taxed correctly, and there's certainly some premiums which aren't even being allocated correctly. But if we're writing in this manner, in a non-authorised, not permitted, not admitted, not permitted scenario, we really are concerned at the regulatory side, generally. You look at countries such as Italy, where we've tried to do various pieces of work, and the answer back from the Italian authorities, the tax authorities and the regulator there talk to each other very closely, and indeed the registration for Italian IPT is linked to the regulator. You need to have the regulator certificates and so on. So it's not possible to file without being authorised. If you try to do so, it would flag up immediately. The regulator would be all over you, and you're looking at quite significant fines and threats of imprisonment. It's quite serious business for the Italians. Similarly, in Spain, there are issues there, certainly on the consortio side. They're saying, look, we cannot take taxes from you unless you're authorised, or we cannot take the surcharges from you unless you are authorised. There's no way it's going to happen. And if you do come to us and try and settle it, well, we might have to tell the regulator that you've written this premium and you maybe shouldn't have done. And you may have to then sort of deal with the regulator for those consequences. Interestingly, in Spain, the IPT authorities, the central tax authorities in Spain, which are separate, completely separate entities to the consortio, when pushed on this question, said, well, you know what? To register with us, you don't need to be authorised. We don't care what the regulator says, and we'll quite happily take your money, but we're not going to say that you're not going to be chased. And if we're asked, we will tell the regulator that we're doing this. So there's a way to pay the tax, but it's one that's probably going to cause more complications further down the line.
Say, for example, Ireland, where we're able to file taxes. If someone had, say somebody wrote from Guernsey, lived to Ireland on a non-admitted basis, but they paid their taxes, and there was a large claim, like a large fire, property programme, and the regulator got wind. Surely the regulator would penalise that insurer less than finding a Guernsey-based insurer who hadn't paid their taxes and had written on an admitted facility had to charge that. I'm not asking for the answer.
No. It's well. I mean, this is the grey area. Is that we quite often find that there are insurers and captives that have put together programs, and they've even gone to the effort to allocate the premium and work out how much tax they should be collecting and paying, and collected the taxes. But then they can't discharge their obligations to the authorities. The authorities won't accept the taxes, and I suppose in your example there, it may be a balance of values. If you've gone ahead and written a program and you've got a few taxes, it's maybe €1,000 of tax in Ireland, it might just be easier to pay it and keep under the radar. If, however, it's quite a substantial program, the authorities might not be quite so willing to turn a blind eye and just accept it, because it's going to throw alarm bells for them, and they would have to answer to the regulator. Well, you knew this insurer was based in Bermuda, and you quite happily accepted that. They've said we will have to tell them. You shouldn't be doing this. We would have to tell them. So it is a grey area, but quite right. How would the regulator deal with an insurer? Would they deal with them differently if they had settled the taxes or not? I don't know. I'm not in the regulatory sphere.
So I think possibly, I hate to say this, it's probably even more complicated, because in many territories where non-admitted isn't permitted, the rules say that non-admitted insurance shouldn't be purchased. And actually, if you take that example of Guernsey captive on Ireland, it's not within Irish jurisdiction, and it's operating perfectly legally within Guernsey.
Yeah.
So if you actually declare your taxes, what you're really doing is in the case of captive dropping the parent company or the parent subsidiary.
Yes. Yeah, absolutely. I mean, it seems to be quite a common theme, is that essentially, the idea of whether you can go out of country and purchase from a non-EU insurer is not specifically addressed, so it's considered that you can do it. But the tax law doesn't link up with it. And this is that. I mean, that's the real problem, is that the tax law is not built, and that the tax authorities are not built for dealing with these non-admitted policies. I mean, the UK, if we go to exceptions to this rule, and as Peter said this morning, and I would like to echo what he said, HMRC is one of the most reasonable tax authorities when it comes to premium taxes. You might think otherwise in terms of income tax or corporation tax, I don't know, but in terms of premium tax, they are very clear and very pragmatic about the whole issue. So they will quite happily accept your premium taxes. They don't even require you to appoint a fiscal representative for a non-EU insurer. And are very useful and helpful in getting you to settle your liabilities, which is quite a contrast to the Italian model. And I don't know. I sort of feel if there's somebody that's wanting to pay you money, take it. But maybe they don't want to encourage. Yeah. So I'd like to just now share a few experiences that we've had with insurers and captives writing programs, collecting taxes, realising that they've got this liability and trying to discharge it. So this first one's quite a good story, really, in terms of the success. It's Belgium and Netherlands, so both very reasonable countries in terms of IPT law, or the tax authorities' attitude towards it. Had a global policy with risks in both Belgium and Netherlands, and there was actually co-insurance arrangements. So the Bermuda insurer was maybe neglected a little in the putting together of the program. It wasn't really thought through. Nonetheless, premium taxes were collected but not settled because this Bermudan insurer didn't know how to, didn't have any facility to pay taxes to either authority. As we can see there, not not insignificant sums of money, 150,000 euros of taxes due in Belgium and 400,000 in Netherlands. The way that this was dealt with was that the policyholder actually decided that they wanted to take the lead in this and settle on behalf of the insurer, so the Belgian and Dutch domiciled policyholders paid away the taxes, and because we did this through a voluntary disclosure mechanism, in fact we wiped all penalties, and I think to date we're still waiting to hear if they're going to impose any interest on it, but it's been a few years now, so I doubt we will. But certainly the Dutch and the Belgian authorities are ones to not really tell you when they've decided to close a matter.
So if the insurers collected the tax or the premium, what happened to the tax they collected?
Well, this is the problem, is that if they've collected the taxes with the premium, they've got it sat on their books. And they can't write it back into the books because you can't profit from taxes. Equally, you can't pay it away because the authorities won't necessarily take it. So you've got, I mean, in this instance, we were able to discharge the tax liability, but you do have scenarios where actually you've got taxes that you've collected that you can't get rid of. And that's, we're going to come on to in a little bit, what can we do about that?
The policyholder didn't have to pay the tax twice, in other words.
Sorry, no, the policyholder submitted the taxes, yeah. Yeah.
Insurers often have, the large insurers often have like a large pot, and that's dreadful to say, but sometimes they keep hold of it in case somebody comes asking for the money. Then sometimes it's difficult for them to return to the policyholder because they have to explain that they haven't paid.
Yeah. Next experience, Ireland. It was this instance was a one-off policy. Written by a Bermudan insurer, only covering Irish risk on a liability policy. The insurer wished they'd never done it. It was a mistake, but it had been there. They had collected 20,000 euros of taxes with the premium, but they'd not paid it on to the authority. They actually made an approach to the Irish regulator on a no-names basis, and the Irish regulator says, don't come and talk to me about this because I'm going to have to do something about it. And if you haven't given me a name, there's nothing I can do about it, but I don't want to know. So they just sort of shut the door on them, really. As we said, the revenue were more open to receiving the money, so voluntary disclosure was made to the Irish revenue. And again, because it was a voluntary disclosure, the penalties were significantly reduced. In this case, only a 5% penalty plus interest was applied. To have submitted or to have not submitted and been discovered, whether they would ever have been discovered is a good question, but potentially 40% penalty for unprompted disclosure. For prompted disclosure. Slight mistake on the slides there. One last quick example, something of sort of ongoing stuff is a Guernsey domiciled captive writing a global PDBI, and they front in a number of EU territories where they know they're able to pay away the taxes. Otherwise, the programme's fronted. Those countries that are doing it is Belgium, Germany, Netherlands, and UK. And in fact, it's fairly small amounts of premium tax that they're looking at in all those territories. I'm going to whiz through this. In fact, I'm not even going to bother with this bit because this is sort of off course, really. This is sort of what we have to consider when we're settling the taxes. If you want to sort of think about all those issues of registration and calculating invoicing, then I'm happy to discuss with you later. So we've identified the taxes, and as those previous examples have shown, the value of making a voluntary disclosure. If you want to do something about it, the best way to do it is the voluntary disclosure. Be open and honest, normally mitigates the penalties. Flip side to that is, if you don't do anything, will the authorities ever find out? Well, arguably not, because their reach is not that great, but you're left with that problem of your taxes on your account. So I think this is the interesting one to finish on, really. what happens if we're unable to settle? What happens if we have taxes that we've collected for Italy and the authorities won't take them? In fact, actually, just to go back to Italy, I have heard stories of people that have said, look, we want to pay you the taxes, you're not going to allow us to register, I'm going to write you a cheque and send the cheque to the authorities with the tax, and just look, cash it, it's off our books then. And the authorities very kindly return the cheque to them in post saying, sorry, I can't accept that. So possible solutions. First of all, is there really tax there? If you're really in a bind, you could maybe re-examine the policy documents, re-examine the allocation that was performed. Maybe we've been too hasty in deciding that there were premium taxes to be allocated to Italy or Spain or wherever. So really drill down into the policy, the contractual route. What is going on there? Do we really have the IPT liability? Then obviously you can just say, right, well, I'm not doing it anymore. It doesn't necessarily help you with previous taxes, but you say, going forward, I'm just going to get everything fronted. You know, it's too much problem for me to be trying to deal with these taxes. Let's just get the contract fronted, or even to reissue the policy, annul the previous policy, and say, look, that was never there. I mean, this is then going into sort of issues with the policyholder and maybe some regulatory issues, and it may not be a desirable route, but that would be a route if the contract is cancelled and no premium received. Then, well, maybe there's no tax liabilities have arisen. One solution that's often put forward is the financial interest cover, which you can insure the books of the parent company in wherever, US or Canada or wherever, which from a premium tax perspective works wonderfully. Because in that case you can say, okay, the insured risk really is with the parent company. Problem is maybe then when you need to pay claims out to the various subsidiaries, and you might get some sort of corporation tax or income tax paid on those transfers from the intercompany transfers from the parent. The final solution, which is one we sort of mentioned before, is the possibility of the policyholder or broker settling the taxes. If they're in country, they may well be registered to pay taxes. I mean, certainly in France, you can, as a policyholder, you get one tax ID number and you can submit an IPT return. The authorities might well say, well, hang on a minute, you're a food manufacturing company, why are you sending me an IPT return? And they might ask a few more questions, and then you might get involved with the regulator that way. But in terms of getting it off the insurer's books, in terms of having that tax liability there, that's certainly one way of working it. So I think that's really all I have, unless anybody has any questions or comments or anything they'd like to look at. I hope it's sort of given a little insight and into sort of the issues that are there.
Do you think, in your view, you're seeing many clients set aside liabilities on top of the actual tax due? Is there much of an appetite for them, or do they just wait until maybe the regulator or tax authority respond?
Well, the number of instances that I've seen suggest that actually a lot of people aren't really too worried about this at the moment. Certainly,
when you eventually get to
when you end, it could, yeah. Certainly, I mean, it's even coming back to the sort of the excess layer policies, where the link is not so easy to see. And under EU law, well, really, you should be apportioning some of that premium to where your risk is located, and therefore account for the taxes that would be due in that country. I think that there's probably a bit of head burying in the sand on this one, simply because I've not seen very many people admitting to the problem, or maybe they're just not admitting to me, I don't know. But it's certainly, I think, becoming more and more of an issue. What I'm seeing is that it's really the issue where they have decided they've got the taxes, they've collected the taxes, and they've got this liability sat on their books that they sort of need to get rid of. The auditors aren't very happy with it being sat there, and they need to get rid of it somehow.
Question, do you think there's any likelihood of any tax authority challenging the financial interests?
To be honest, I don't think they're sophisticated enough to start thinking about that at the moment. You know, they haven't even specifically addressed these ideas of the excess layers. You know, they're really focusing on the very easy, you know, the low fruit. That's where they are at the moment. In the future, I think quite possibly as the tax departments become more and more sophisticated, I think it would be a very good one to challenge. I think if you look at maybe some of the VAT cases that have gone around, some of the principles of VAT, you know, what does the consumer think they're getting? You know, you can dress it up as a financial interest clause, but essentially the entity in the UK and wherever is getting the benefit of it. So I think there's probably strong grounds, but I've not heard of any movements or rumours to do it, and maybe it is something for the future, but at the moment they're sort of the big fruit really for tax authorities are the large domestic insurers, and that's where they focus all their attention. You know, in the grand scheme of things, even the biggest captives are writing tiny premiums compared to, you know, the AXAs and the.
Look at the volume of most business.
Well, exactly, and that's where, I mean, you see it in the UK. That's where all the legislation's focused, is on those sort of high volume areas.
Does a financial interest kind of policy or more indeed a fronting arrangement differ from the sort of arrangements that probably exist today on sort of group policies and restricting the risk then? Because if you went to most people, you know, a US company insuring with a Bermuda captive with UK and European subsidiaries, it would say, well, I've just got an offshore policy.
Yeah.
And as far as I'm concerned, it's my risk. I've insured the risk. I've got operating subsidiaries, but I'm hedging them.
Yeah.
In effect, I'm not charging them.
Yeah.
I'm going to take all the loss.
And this is where the EU really sort of comes up against the buffers with the rest of the world in that sense, with that Caverna, those principles laid out in Caverna, is that it says, indeed, the Germans have just written into their IPT legislation this idea about global policies, global liability policies especially, saying, I don't care where your policy is written, I don't care what you say is there, you've got a policy holder or an insured underneath that policy in Germany. We therefore want some of that premium to be allocated to Germany so that we can then tax that accordingly.
So how would you write your fronting arrangement to make that?
Well, in that case, if you have a fronting arrangement, then your insurer, your fronting insurer, will deal with all the local taxes.
Oh, right, okay.
So you know all of your tax obligations, you know, as a reinsurer is just shove it to the fronter. Yeah.